This is Econ Solutions, looking at oligopoly and concentrated markets in the Unit 3 topic content. So firstly, I want to talk about what an oligopoly is and then define concentration ratio for you, as that will be important in your essays to discuss what an oligopoly is and where it comes from. So an oligopoly is essentially a market structure, so it's one of the market structures in which a few firms dominate the market share. So it's shared between a few firms and it's highly concentrated. So if you think of something like supermarkets or recently electric companies, these are good examples of oligopolies. So within an oligopoly you have a concentration ratio. So the concentration ratio can be made up of 4 firms, 5 firms, 3 firms. It doesn't really matter as long as it's defined by sort of a few firms. So not loads, but a few firms that dominate the market share, and it's the percentage of that market share that these few firms take up. So if 4 firms take up 75% of the market, that would be their concentration ratio. So I want to talk about now price rigidity in oligopolies, because it is said that within oligopolies prices are rigid. They tend not to move up or down too much or fluctuate too much. And one example given as to why this is the case is to do with the Kinked demand curve. So I'm going to talk you through the Kinked demand curve and explain why people argue this is a reason that in an oligopoly prices remain rigid. So the first premise within the Kinked demand curve is that you have your price point at X seen here. And at this price point, it's argued that all your firms in the oligopoly, so in that concentration ratio, operate at this point X. Now, the theory goes that if firms want to increase their price, they face this elastic demand curve. And if they want to reduce price, they face a very inelastic demand curve. Now, I'll explain why that is. So if you increase your price, it's said that not many firms will follow. So if not many firms are going to follow this increase in price, then most people will still be purchasing the goods at this price X. So not many people are going to follow you and increase their price. So therefore you're going to face an elastic demand curve, because people are going to automatically move to the alternative company that's selling the same good at this lower price. If it's something like petrol, if you think it's exactly the same good, so there's very little incentive to stick with that company, you're just going to go to another company that's selling at price X. So you face an elastic demand curve and have a proportionately larger decrease in output with a small increase in price. So as you can see, it's such a small increase in price, but this gap here is huge because you face that elastic demand curve. So your output falls proportionally larger than the price rises. However, it's said that you'll face an inelastic demand curve if you lower price. Now the reason for this is if you lower price, other firms are said to follow suit. So other firms will lower their price as well. So even if you lower your price by P2 to P3, which is quite a large increase, you'll actually only get a small increase in your profits. So as you can see, if you raise prices, you'll face an elastic demand curve, so you'll lose a lot of business by raising your price by a small amount. And here, you won't gain a lot more output at the given price because firms will follow suit, so you probably won't make as much profit. So firms tend to stay at this point X, and prices stay rigid, and that's sort of one explanation is this Kinked demand curve. Now this can come under criticism because no one really states like how you got to this point X as being your price point. But that said, it's still a concept you need to learn, and it's important that you can build on that and explain and evaluate why prices are rigid and give a few examples as to the reason for this in your A2 exam. Another Kinked demand curve theory is that there's price rigidity because firms won't actually have to move their price. So before it was that they didn't want to move price in the previous Kinked demand curve. In this Kinked demand curve example, I'm going to explain why firms don't have to move their price. And it's to do with their marginal cost and marginal revenue, where it's placed at this point of the kink. So if you see, again, we have our average revenue curve that has that kink in it. So our Kinked demand curve. But if you now bring in the marginal revenue and marginal cost curves, we know that where these meet, it's actually the profit maximizing point. So you can see there's, as long as you're working along this line, as long as you cross along this point, anywhere along it, your marginal cost is equal to your marginal revenue. So you're profit maximizing here. So as we can see, it discontinues here. Now the reason for that is if you look at this diagram here, you see that the marginal revenue goes along as such, because the marginal revenue is always twice the average revenue. So it goes along twice as steep as this average revenue curve. But when there's a kink in this average revenue curve, it becomes twice as steep again. So it joins at this point down here. So there's actually a gap, a discontinuation between these points at the kink, because the elasticity is actually twice as steep. The curve, the MR curve, is twice as steep as the AR curve. And therefore at this discontinuation, we can see that if firms change the price, their profit maximizing point won't change. So there's no incentive, they don't have to change the price. So actually their prices will remain rigid as long as their MC and MR curves lie at this point where the discontinuation is. So that's another theory as to why prices are rigid in an oligopolistic market. Now there's also different theories to do with how prices are made up in concentrated markets or oligopolistic markets. And I'm just going to take you through a few key ones. So the first one is cost plus pricing, which exists quite a lot in business, and it's the idea that you just mark up pricing. So you essentially put your average fixed costs and variable costs, which make up your total costs, and you just add on a profit margin and you gain profit from that extra that you're adding on from your costs. Okay, as we know, the markup, so minus your costs, will give you your profit margin. So oligopolies that aren't competitive, these can charge a larger markup, because essentially if there's a few firms that are dominating the market, they have what's called monopoly power. Now this is not to be confused with a monopoly. Monopoly power is just something that has attributes of a monopoly. So for instance, it might be that there are high barriers to entry in an oligopolistic market as well. So they're exercising their monopoly power to actually increase this profit margin here. So the next thing I want to talk about is price leadership and price parallelism. So this is the idea that one firm takes the lead in raising or lowering prices and other firms follow suit. So the other firms will go along with this price increase or decrease as not to lose out or get in a predatory pricing war. So essentially this can be done with or without collusion. Collusion is supposedly illegal, but there might be some tacit agreement between firms to say, okay, we're going to all rise our prices to take advantage of the market and gain as much profit as we can. And they tend to agree with this price leadership idea because they know they can actually increase their profits, albeit they might be reducing consumer welfare as well. Another form of pricing is limit pricing. So this is seen as sort of like anti-competitive, because essentially you're not trying to compete with firms, you're trying to actually push firms away or put firms off the market. So you lower prices so much, so incumbent firms mean that you're already in the market, and you lower these prices to such a degree that you sacrifice these short-term supernormal profits for long-term profits by putting your prices so low that no one can enter the market. There's no incentive for anyone to come into that market because no one's making profits. So they do this so that they can make profits in the long run. And now the opposite of this is predatory pricing, which I'll talk about next. So predatory pricing is a similar idea, as I said, to limit pricing, but instead the incumbent firms are sort of competing with each other. So you're no longer trying to put firms off coming into the market, you're actually trying to push firms that are already in the market out of the market. And it tends to be these new entrants into the market that you're trying to push out, because they might not have as many resources or be on as a larger scale as you, so that they maybe can't afford to lower their prices for as long as you, and therefore they have to leave the market as they're not making those normal profits. So the new entrants into the market the firms already in the market may adopt a predatory pricing method and push these new entrants out. And that's essentially predatory pricing, where you keep lowering your prices, possibly get into a price war, but then the firm that's been there the longest is probably likely, or the firm that's the biggest is more likely to sort of stay alive or stay afloat in that war, and the new entrants will have to leave the market. The final thing I want to talk about is price discrimination. Now, this is quite a big topic within this Econ Unit 3, so I'd suggest you read up a bit more, and I might do an individual video on price discrimination, but in the context of oligopolistic markets, I just wanted to mention it briefly. So it's essentially where people are charged different prices for the same good. So if you have perfect price discrimination, firms are charging the maximum amount to each customer, because each customer is willing to pay different amounts for different goods. You know, your consumer surplus will be slightly different than another person's. So therefore, if you're charging, as a company, you're charging the maximum you can to that customer, then you've got what's called perfect price discrimination. Now, examples of price discrimination are like car parking, airline travel, anything where you see something like peak times and off-peak times, because essentially it's the same product, you're still going to the same place, but obviously more people want to fly at that point, so therefore they've got a more inelastic demand curve, and therefore they're willing to pay a higher price, so they will raise their prices for those specific people, and that's essentially what price discrimination is. So I've just taken you through briefly what an oligopolistic market is, some of the reasons why people believe there's price rigidity in the market, and then some of the pricing structures that exist.